Let's take a look at Chapter 3. Chapter 3 is about analysis of financial statements. The main topics we'll talk about here is really ratios. So when they talk about analysis of financial statements, what that really means is we're looking at a company's financial statements and essentially tearing them apart. And we're using ratios to analyze them so that we can better draw conclusions about the performance of the company. And that matters in finance, that matters in accounting. In finance, we do that to try to figure out what's the company performance like. Is this a company I want to buy stock of? Do I want to invest in this company? If I work for the company that I'm analyzing, I'm trying to figure out my results. What are some things that are not performing well or are performing well? And it helps us to understand how our operations have went so that we can make better decisions about running our company, managing it, looking at our competition, and making good decisions about the future. So it's really just about understanding your financial statements and then comparing your performance over time. So it's very common you look at your current year performance and compare that to previous year's numbers. I could look at a key competitor, compare their numbers to mine. I could compare my numbers to an industry average. So the key with financial ratios is benchmarking, is what are my numbers compared to something else, and that allows me to draw conclusions about performance and then make adjustments as needed. Okay, so that's a lot that deals with that. A really good resource besides your chapter, of course, which is always a good resource, and all the stuff you have in MindTap, there's all kinds of videos and whatnot in MindTap that'll help you. I also want to make sure you're looking at the accountingcoach.com website. So this is just the main page of accountingcoach.com. And then one of the links on the left-hand side is called Financial Ratios. So I'm just going to click on that. And I just want you to see that. If you want to take a look at this just to kind of help you understand it just a little bit more, that might help you. Don't worry about buying the pro features and all that. But there might be a few things in here that are useful to you to take a look at: the explanation in the 4 parts, the practice quiz, the review Q&A. You might find that interesting. So if you feel like this is a kind of a foggy area for you, by all means take a look at that. Okay, so let's come back to the chapter then. And every chapter starts us out with basically this slide, and they'll point to what we're talking about. So we're really looking at net operating profit and required investments in operating capital. And then down here, we're looking at debt to equity mix and business risk. And ratios will help us kind of figure out all these components. We're going to analyze those components in more detail using financial ratios. And I've already kind of mentioned some of these too. And just think about who uses ratios. Internally, management and ownership are using ratios to determine areas of strength or weakness to kind of figure out how the year go and what kind of adjustments should we make based on that. If I give my financial statements to a bank in order to obtain a bank loan, I promise you what the bank will do is run the numbers all through their internal software, and they're going to crunch out a whole bunch of ratios, and they're going to figure out, hey, if we give this company a loan, will they be able to pay us back? And the middle one is stockholders. Basically trying to figure out what's future cash flow look like, how much risk is in the company, what's future profitability look like. Again, we're trying to make judgment calls. So what they'll do is just give us an example. They're giving us a company, the 2019 numbers are actual, and the 2020 numbers are E for estimate. So we have a 19 actual, a 2020 estimate, and basically here's what we think the numbers will be. And so this is an income statement, a very consolidated one, which is just fine for what we're doing. Sales minus cost of goods sold, other expenses, depreciation. Then remember what EBIT is, earnings before interest and tax. I back out my interest expense. I get down to EBT, earnings before tax, net income. Then the balance sheet is, remember what the balance sheet does? It shows assets equaling liabilities plus equity. This is just the asset section. And we have current assets and then fixed assets. So cash, short-term investments, receivables, inventory, that's total current assets. And then net fixed assets is on top of that to get down to total assets. And then we look at the liability and equity side, kind of the same thing. I've got current liabilities, my accounts payable, notes payable, accruals. We've got long-term debt, total liabilities, common stock and retained earnings, total equity, and so on. Okay, so you can already kind of make some judgments just based on this. Coming back to the income statement, sales go up, that's good. Go by 600,000. Cost of goods sold goes up, which makes sense because sales went up. Good news is they didn't go up as much as sales. Cost of goods sold went up by 410,000. Other expenses went up by 50. Depreciation went down. Interest expense went down, and so on. So profitability increased between the 2 years. That's good. On the balance sheet side, our cash position improved a little bit. We got a little bit extra short-term investments. My AR went up a little bit. That's not alarming because sales went up. Makes sense that AR would go up. Kind of the good news or the surprising one is inventories went down. While sales went up, inventory went down. So that tells me maybe we had some inefficiencies with our inventory management and we were better at managing that. And net fixed asset went up just a little bit. On the accounts payable side, good news here is our payables go down. Even though sales go up, payables go down. So we're better at collections, clearly. Notes payable goes down, so we paid some principal off of that. Accruals goes up a little bit. That's very common when sales go up, accruals go up. Long-term debt stayed the same. Common stock stayed the same. Retained earnings went up a little bit, which tells me we had net income for the year. And just some data to look at. Earnings per share for the 2 years. That's your net income divided by the number of shares outstanding. Dividends per share is the amount of dividends paid per share of stock. It went up a little bit. Book value per share, 29 to 32. Dividends paid were 84 versus 100. The number of shares didn't change. Year-end stock price went up, which makes sense because we had increased profitability. Our financial performance really was good between the 2 years. Lease payments were the same in our tax rate. So then what we'll do next is give us examples of ratios and explain what the ratios do. So I will just tell you the way that this will work when you do the homework problems in MindTap is just have these ratios in front of you. They're in your ebook. They're also on the PowerPoint slides. So as I've mentioned previously, a good strategy when you're doing your homework problems is have 2 screens or 2 devices. Download the Cengage app onto your smartphone, and you can have your ebook on that while you do problems on your laptop, or if you have more than one laptop or a tablet computer of some sort, I would recommend that you have your ebook on one device and then your problems on another device. Another thing to do would be print out these PowerPoints and have them near you. Don't have to print them out full page. Like when I print them out and I make notes for lectures, I print them out 6 per slide, and that still gives me room to write notes and kind of just give myself some comments that I want to remember as I do a lecture like this. So those are just some things you can think of to help you do this. If you have the actual physical copy of the book, that's the easiest, of course, but not everybody does. Okay, so what they'll do when you do these problems in MindTap is they know you know the formulas. Okay, so just kind of keep that in mind. And so they're going to maybe not give you the formula straight up. They're going to give you different parts of the formula to solve for. Like they might give you what the answer is, but make you solve for some specific part of the formula itself. And you'll kind of catch that after a while. You'll kind of figure out what the pattern is. In MindTap, remember that there's all kinds of really good videos for you to watch. So just watch those videos. They show you step by step how to solve some of these problems. So I just encourage you to do that. Okay, so profitability margins, why they exist. We're trying to figure out the profit margin, operating profit margin, return on assets, earnings power, return on equity. Those are some of the key ratios that deal with profitability. So what they do next is they just show us the formula, what goes into the formula, and then they compute it for us, which is really easy. Formulas are really easy to do. So you have the formula in front of you, plug the numbers, do the math, you're fine. The key really is, what do the numbers mean, right? And ratios have meaning when we compare them to something. So in the example here, we have 2 previous years worth of ratios. We have 18, 19, and then 20 in the industry average. And so you can see a trend here, right? So 18 was not necessarily, or was our good year. 19 was a bad year. The good news is that the current year is much better. So the current year, we've improved. Now, however, we still have room to grow, right? So we could hopefully get back to our 2018 profitability, and the goal should be to get near the industry average. So profitability says, what's the markup? How much profit margin do I have when I sell a good? An operating profit margin is your EBIT. So net income is after every single expense, after interest and taxes. EBIT is our margin before interest and before tax. So that's going to be higher, right? And you can see again kind of the same pattern that we had here, we have here with our numbers. And so that's really the key to me. The big takeaway that I want you to have as master students is, think about, what do these trends mean? What do these ratios mean? Anybody can do the math on these. I could give these formulas to 5th graders. I promise you they could do the math. The key for us as master students is, what's the meaning behind the numbers? So if you were given the task of analyzing these ratios, and your job was to explain that to a management group or board of trustees or board of directors, how would you do that, right? So I want you to be thinking about it from that lens. How would I explain these numbers to a group of people that maybe didn't understand that I could add meaning and value to this? So think of it from that perspective and just follow the trends, right? And the key is why this is happening. Now, we don't know that because we're just given numbers on a PowerPoint and calculating numbers. But ideally, I have an answer of why we were able to increase our profit margin from 7.7 to 9.4, right? I would know, I would have some specific strategies that we implemented that resulted in that increase, because I would expect the board to ask me that. How did you do that, right? So I want to have the answer to that. So basic earnings power is taking your EBIT divided by total assets. You get 12.4%. And you can see, again, kind of trended along the same way that the other ratios did so far. Still below average, room for improvement. That's kind of the common trend here. So kind of just keep that in mind. A lot of these ratios will trend the same way. So that means whatever made them go down or go up will affect several ratios. So whatever the answer is that caused this pattern, it affected 3 ratios so far. Return on assets, it measures the efficiency of the use of our assets, net income to total assets. How efficient are we at taking our assets and turning them into net income? And same thing with common equity. How efficient are we at using our equity to earn net income? And it'll kind of show us the trend on those. So 18 wasn't bad. 19 was clearly a bad year. Everything trended down. 2020, the good news is everything's trending up, but the general pattern has been, good news is we're going up from 19. Bad news is we're still below industry average, and that's been the common theme so far. So ROA and ROE, what's the effect on debt? Okay, so return on asset is lowered by debt. Interest expense lowers net income, which also lowers ROA. However, use of debt lowers equity, and if equity is lowered more than net income, ROE would increase. So, and that's the classic, what's the proper mix of debt versus equity that every company has to figure out, right? Too much debt is bad. Some debt's actually okay, because for corporations you get a tax deduction for interest expense. So it's finding that right balance between the two, and how you want to impact ROA versus ROE. And with the asset management ratios, then the next group, how efficiently did we use the firm's assets to earn sales or earn net income? Okay. Then the next one is inventory turnover, and basically how much did our inventory turnover for a given year? And you can see it's cost of goods sold divided by inventory. So you can see the math here. Higher is better. And keep in mind, with some ratios, higher is better. With some, lower is better. With this one's higher is better. The more I turn it over, that means the more I've been selling. So I want higher to be better. Good news is, like the other ratios, 19 was a bad year. It dipped from 18. 20 is a good year. It's going to go up, but we're still below industry average. Okay, so I kind of already mentioned that. And then DSO is days sales outstanding. The average number of days from a sale until cash is received. So it's receivables divided by average sales per day, and that tells me how long it takes my customers to pay me. In this example is 29 days. And so you can see here, 26 days, it went up to 31, goes down to 29. And remember that our receivables balance went down between 19 and 20, which tells me I was better at collections, still above industry average. Now remember, this has a little bit more meaning too when I compare it against what is my sale terms. So when I sell to my customers on account, what are the sale terms that I use? And if I use 30 days and I get paid in 29 days, hey, that's good. I'm okay with that. So that's the key with this one, right? Now, if my credit terms were 20 days and I'm getting paid in 29 days, that might be a problem. We don't know what the credit terms are, but that's what you kind of look at. Then fixed asset and total asset turnover ratios is basically saying how good are we at using our assets to generate sales. We're looking at just fixed assets in the top one and total assets in the bottom one. So total assets includes fixed assets plus our current assets, and net fixed assets is just the property, plant, and equipment. And again, we'll kind of look at the ratios here. Better than previous year, but again, not up to industry average. We have a lot of fixed assets compared to our sales, and that's basically the reason for it. Liquidity ratios. Can we pay our bills? Okay, that's basically what we're trying to figure out. There's two main ones. Current ratio is the CR. Quick ratio is the QR. Current ratio is current asset divided by current liability. Above 1 is generally considered to be good. The quick ratio, all we do is we back out inventory. And the reason we back out inventory is if I am a wholesaler or a manufacturer, I have to sell my goods and then collect, right? So it might take me a while to sell, and then if I sell on account like a manufacturer or wholesaler would, I have to wait to get paid, maybe 30 days, maybe longer. So it's not quite as current as receivables and cash. So I just back that number out. Typically that number is below 1. Okay, so you can see here, again, same pattern that we've had with practically every other ratio. We're still below industry average. And for our industry, our liquidity is actually kind of weak. Okay, it's not near what it would be for our industry. So debt management, do we have too much debt? And can we service our current debt with basically our current earnings? And then leverage ratios, the debt ratio, total debt divided by total asset, very simple one to do, not difficult at all. And you can see what that turns out to be is 24%. And total debt includes long-term and current debt. We had note payable and long-term debt, so I have to include both of those. So how much debt do we have compared to total assets? And then debt to equity is just simply debt divided by equity, kind of the same formula here. Just we divide by equity instead of dividing by total asset. And then liabilities to total assets is just all liabilities divided by total assets, and we get the number right there. And then my equity multiplier is total asset divided by common equity. And then times interest earned, they call it tie ratio, is my EBIT divided by interest expense. And my EBITDA coverage, a little bit more going on here. Basically, it's the amount of my EBIT plus depreciation and amortization, which is a non-cash expense, plus lease payments divided by the sum of interest expense, lease payments, and loan payments. So, what do these all mean? And you can see here the trends, and the trends are very similar to the previous ratios. And you can see we have more debt than the industry. Our debt to equity is higher than industry. We have more liability to asset than industry. Earnings multiplier, though, is higher. That's good. Times interest earned is low, and our EBITDA coverage is low. Okay, so the key with this one is we have more risk than the industry. Almost every ratio is worse than the industry. So that just tells us that our business has more risk built into it than most companies in my industry. And market value ratios incorporate high current levels of earnings and cash flow, increase these. High expected growth in earnings and cash flow, increase these. High risk of expected growth in earnings decreases these ratios. So basically, if there's current high earnings and an expectation that there will be high earnings going forward, that increases stock price. Okay, duh, that makes sense. However, if there's a lot of risk associated with earning these things, that would decrease stock price. Okay, so the PE ratio, price to earnings ratio, is this company, the price is $49, earnings per share was $3.90, so my PE ratio is 16.8. So the PE ratio is how much investors will pay for $1 of earnings. The higher the better. So for our company, investors will pay $16.80 for $1 worth of earnings. So then we have the market to book ratio. So book value per share is the equity number, our stockholders' equity divided by the number of shares. We get $32. So market to book is the price of the shares, the market price divided by book value per share. We get 1.53. And so higher is better. And then basically how much you'll pay for $1 book value. And you want that higher is better for sure. Okay, so we can compare those again to industry averages. And again, it's lower than industry average. It's trending the right direction from our bad 19, but still well below industry averages. Okay. And another thing we can do is what they call common size balance sheets or common size financial statements. And for the asset side, we take every single individual amount and we divide it by total assets. So the sum of this has to equal 100%. And what's nice about doing this is you can see trends in the components of your balance sheet. So as I look at 18 to 20 compared to my industry average, you know, my cash position, my short-term investments, my receivables, inventory. Inventory tells a good story here, right? So we know that sales have gone up, but inventory has gone down as a percent of total assets. That's good. That means I'm more efficiently managing that number. Okay, doing the same thing then for liabilities and equity. And I divide everything by the grand total of liability plus equity. And again, that tells me how does the components of my balance sheet change. Like my AP going down, that's a good sign. Most payable going down means I borrowed some money in 19, but I paid it off in 20. Accruals go up as sales go up. My debt number hasn't really changed a lot. And my equity, you can see, has gone up a little bit between the 2 years here. Okay, and the company I'm looking at is called Computron, and they're just kind of giving us some analysis of what that looked like. I can do the same thing for my income statement. I divide everything by sales. So I take every single amount of my income statements and I divide by sales. So sales divided by itself is 100%. But this helps me kind of see what my cost of goods sold percent is, my depreciation, other expenses, my EBIT percent, my net income percent is down here. So, it's really kind of helpful to see how these percentages trend over time and how they compare to my industry average. It kind of helps tell a story about the company. Okay, and then this is just the accumulated change. So basically, just 18 was the base year, and then we look at 19 and 20, and this just tells us how do these numbers change compared to the base year. The base year is always set at 0, and then 19 went up 9.1% from the base year. 20 is up 20% from the base year. This helps us understand growth. Okay, in that 19, I should mention that one. So 19, sales went up by 9%, but we lost money, right? This other expense thing going up by a lot. Cost of goods sold, depreciation. So sales went up by 9%, but 3 categories of expenses went up by more than 9%. We have a loss, right? In 20, thankfully, it rebounded. So 20% increase in sales, and yes, other expenses increased, but those increases were based on smaller dollar amounts in sales, and so we ended up having a net profit, thankfully. So our profit margin rebounded. So the same thing, I do the same thing with my balance sheet with my assets. Kind of helps us figure out some big swings from year to year, and help us understand, kind of why those happened. Okay. In this one too, let's look at inventories. Inventories went up in this 19 by 32.3%, right? While receivables went up by 30%. Not good, so that tells a story. Inventory, we got that down to a better number in 20. My receivables went up only by a smaller percent in 20 compared to the base year, so I kind of settled that out a little bit too. And I look at my accounts payable. That was up high in 19. I was running short on cash because my cash position went down, my short term went down, my receivables went up, my inventory went up. So it's safe to say I was not able to pay my bills, right? And that's why that went up. And I borrowed some money, paid that off in 20, paid off my payables, got that down to a better number, and so on. Okay. So it kind of tells you a story. It just kind of helps you understand what happened to your business. That's kind of what they're telling us right here. Okay, and the last thing to do for the chapter is called the DuPont equation. And what this does is it takes your ROE and it breaks it down into 3 categories. Expense control, which is called your profit margin, PM. Asset utilization, called total asset turnover, or TAT. And debt utilization, called the equity multiplier, or EM. And so the multiplication of these 3 ratios equals your ROE. Okay? So ROE is this number, net income divided by equity. Okay? But ROE also is ROA times your equity multiplier. That's all they're showing us right here. So ROE can be broken down into these 3 categories. And so the total asset over total equity is these 2 numbers multiplied by each other. And then net income over sales is all 3 equals this one. Okay. So basically, profit margin times total asset turnover times equity multiplier is your ROE. So ROE can be computed any one of these 3 methods. You get the same answer. And that's what they do right here to kind of show us that. And the reason that's important is when I break down my ROE into 3 components, I can figure out which of those 3 components is either dragging the number down or making the number look really good, right? I get more detail. The more granular I get, the more detailed I get, the more answers that I can drill into and figure out why it's happening. Okay. So just a few qualitative issues with financial ratios and financial ratio analysis. It's hard to, let's just say I'm Costco, and I do one thing. Costco does one thing. They sell merchandise in their stores, lowest price possible. They only do one thing. But if I'm comparing my numbers to Walmart, well, Walmart has Walmart itself, and it has Sam's Club. And they don't break out those numbers, right? So I can't easily compare my numbers if I'm at Costco to Walmart/Sam's Club because they're all combined together in one set of financials. Okay, so that's an example of it's hard to compare when I'm really competing against a division of another company. Seasonality can distort ratios depending on what time of year I'm looking at the numbers. Companies can employ what they call window dressing techniques. They can maybe get a little cute with some of the ratios or some of the estimates, I should say, especially if they're trying to get a bank loan or do an IPO or something like that. And remember that accounting offers what I'll call a buffet of choices. In accounting, there's lots of choices we have when it comes to choosing accounting methods. So there's different methods for inventory accounting. There's different methods for estimating bad debts, and so on. There's different methods for depreciation. And so if I use one set of methods and I'm comparing myself to a company that uses a separate set of methods, it's hard to make a one-for-one comparison. So that's just what they're telling us there. It's just kind of be to kind of just be concerned about that or be looking for that. Okay, so some other qualitative factors. It says here, and these are some things that we need to kind of figure out, but that ratios will never tell me, right? So one of the things would be, how much of my revenues come from a single customer? That'd be one thing to worry about. How much of my revenue is tied to a single product? How much reliance do I have on a single supplier? How much of my sales are overseas? All of those things are potential risky factors I have to look at. How competitive is my industry? Am I the main competitor and everybody else, I'm the king of the hill, everybody's out gunning for me? Or is it a really competitive situation and so it's just really hard to compete in this business? What products are in the pipeline? Do I have anything innovative and new coming along that might increase my market position and my sales? What's the legal and regulatory environment? Am I selling a product that's highly regulated, or am I selling a product that might result in liabilities? I got to worry about people suing me. So those are all the concerns I have to kind of take a look at when it comes to dealing with these things. Okay, so that is the issue and the situation for Chapter 3. As always, if you have questions, let me know. And always be sure you're looking at the various videos that are within MindTap. They're very useful and they show you a lot of these ratios and so on. So, and just have the ratios near you as you do your homework. Print out the PowerPoint slides. Have that page of your ebook open where they're all at. Whatever you want to do. That'll make it easier for you as you do the homework. Thanks.